Hi, welcome to Let's Talk Bonds, the bond market podcast from INR Bonds. I am Arjun Patsati. We are now entering the season three of Let's Talk Bonds. Let's Talk Bonds has been running for the last few years and has been taking all our listeners through the whatever is happening in the bond markets across the world and in India, and how it's impacting their fixed income portfolios and how it's impacting bond yields and prices. So anything that is to do with bonds in India and in the world is being talked about in Let's Talk Bonds. Now, in this episode of one of season three, we are going to talk to you about the fact that many lenders are showing higher provisions and are facing some bit of stress on their balance sheets. And the blame is on heat wave and elections. Now, this is becoming a trend across all lenders, except for a few banks, except for one or two banks that have shown higher provisions and have cited other reasons. Many of the lenders that are into microfinance and small business finance are saying that heat wave and elections are impacting their efficiency in managing their loan book as well as collection efficiencies. Now, is this a good reason to for higher provisions? And if that is so, then while we had the heat wave, now we have floods across the country. Now, will that also have a effect on lenders' loan efficiency in managing their loan book? Let's discuss this topic in this podcast. Just before that, what I would like to stress here is that many of these lenders have shown very strong improvements in their balance sheets, and many of them have seen their credit rating getting upgraded by rating agencies. So on coming on top of credit rating upgrades, along with the fact that because of the rating upgrades, many of them have seen cost of borrowings also coming down now, and then coming up with an excuse of heat waves and elections for loan book stress. Now, is there something that needs to be looked at upon more closely? It does sound as if that there is a dichotomy here, where on one end everything looks nice, on the other slow signs of stress is appearing. Coming down to the first quarter results of some of the lenders that we are covering here, a few large banks. Axis Bank has reported higher provisions, and they are blaming stress on agriculture on this. Now, is this seasonal? Possible. Axis Bank anyway is a large bank and are able to show higher provisions and manage seasonality in some of their sectors stress. But it does give an indication that anybody else lending to agriculture, especially smaller lenders, are they also facing stress on in their agriculture loans? Then you have some of the small finance banks like AU Bank and Ujjivan Finance showing very high provisionings, multiple times actually in terms of provisionings. AU Finance actually had a merger with another small finance bank, and that I think they're writing off some of that loans. Whereas Ujjivan has not really commented on that, but they have traditionally been showing much higher provisions, really showing that some of the small finance banks who are not managing the risk efficiently on their credit book are facing issues. Um, it remains to be seen what is the reason why Ujjivan Bank is showing higher provisioning. Now, coming down to some of the microfinance lenders like Credit Grameen, Spandana Spurti, you have Mass Financial who are into small business, SME and MSME lending and others secured lending, as well as Five Star Business Finance, again SME and MSME and secured loans. They are also blaming heat wave and elections for some of the higher provisioning and a slight rise in NPAs. Now, while all these companies still have seen rating upgrades and their balance sheets are pretty healthy, along with good liquidity ratios, and who are able to manage their stress, But the question is that if they are saying heat wave and elections for higher provisionings, what about those who are not fundamentally very strong balance sheets, have not seen the ratings move up by rating agencies, and will they and are in the same space as in lending space as these entities? Would they also face provisioning issues on heat wave and elections? Now the question is heat wave and election are heat wave and elections uh, a factor in higher provisioning or collection efficiencies? Uh, Now, yeah, blaming the weather on collection efficiencies, frankly, not really seen it earlier. Um, and I mean, extreme heat wave conditions, maybe global warming, maybe it's a new factor. It does remain to be seen whether this is going to be a continuous factor. Elections typically tend to be a time when there are a lot of spending happening on the ground by the political parties who are campaigning. So given this, and that and given this, typically there tends to be a large amount of money floating around across the across the country as political parties spend on elections, and this actually contributes to higher GDP growth during an election time. And blaming elections on collection efficiencies again, is this something a new trend, or is that the fact that political parties are not been spending so much given a lot of other factors? Also, given the elections, the government too has not been spending too much of in the last quarter. And would that be a contribution to the fact that many of the borrowers are postponing their postponing repayment of their loans? It remains to be seen. Like I said, it's too early to call, and we have to see how the next quarter and the two quarters of that behaving, and whether these lenders are able to show that it's a seasonal trend and it's not a longer term trend in terms of their provisionings, in terms of the weakening of the borrowing profile. Some of the lenders have actually not taking in new customers who are new to the credit, taking first time credit. And that is also showing signs that lenders are getting a little wary on who are they onboarding as customers. The loan growth has been very strong in the last 3 to 4 years. Many of these companies, especially the ones in the microfinance and in the SME and MSME space, have seen very strong loan book growth. And so given this kind of a strength on loan book growth now for the last 4 years, would some of that fast growth start to affect in the next few quarters? Again, it needs to be seen, but definitely something to watch out for, especially for investors who are investing in bonds of these issuers. So it's best that investors go to the financial advisors and take, or if they are capable of uh, going through the fundamentals of the issuer on their own, they should do much bigger, much more study and on the bonds of these issuers, and take a studied, educated investment call. Just to INR bonds does give you all information, but it is best to check with your financial advisor who are qualified to give you the kind of advice, and they would be doing their homework in showcasing some of these bonds to your fire investments. Now, credit uh, given the credit rating upgrades for many of these issuers, they have also seen borrowing costs go down. And given that bond yields have fallen for many of these issuers, and clearly that investors' perception of risk is diminishing it's clearly coming off from on these issuers, and they are willing to give a give a lower borrowing cost. for these issuers, and investors are okay to invest in these bonds at lower yields, given that the yields are still attractive, and the credit quality is also improving. So just to give you a wide perspective of where the bond yields are of across rating categories. So yields in the AA to AA minus space in a 3 to 5 year maturity band are in a range of around 9.5% to 10.5%, depending on the perception of the issuer by investors and the market and the bonds floating around. Going down, the below AA minus, A plus to A minus, they're all in a range of between 10.5 to 13, 12.5%. Some of them also go up to 13%, depending on their maturity profile. And many of these issuers have seen some of the yields come down very sharply, actually, by almost 100 basis points, given that perception of their credit quality is getting better. And going down below A minus, from triple B plus to triple B, they are anywhere in the range of 12.5% to 14.5%, or even 15% for some other sub debt of some microfinance companies. So this is where the range is. And obviously, within this range, it's a very large universe of bonds. And within that, there are those who are fundamentally strong balance sheets and who are still showing signs of worry by higher provisions. Maybe the management is becoming very prudent in showing higher provisions. And being prudent is good for bond investors. But those who are weaker in terms of balance sheets may not be prudent because they don't want to show any kind of weakness, even though there could be on the ground weakness. So investors do have to clearly do the due diligence before investing in these bonds. Clearly, on the risk factor of bond investments, bond credit, any bond that is not a government issued bond is subject to default risk. And apart from default risk, they also carry price risk and liquidity risk. Government bonds only carry price risk, and the impact cost of selling government bonds when interest rates are trending higher can be higher as prices turn volatile. Investors have to take note of these risk factors. Thank you for listening in. Do follow us on all podcast channels, and we will keep you definitely updated on this particular topic as we go along, as we get more and more data. And we will continue to watch these issuers and their spreads and yields very closely and bring the all this information to you, listeners. And do send in any comments and queries to us. You can log into our website, INR Bonds, and contact us. Thank you very much.